Okay, since you understand case 3, what does that mean? What happened? So after after the negotiation, how accounting will record the situation, okay? So on your slide 83, what happened? You are the debtor, right? Because chapter 14 we talk about liabilities, so means you are the debtor, 债务人. So what should we do? We decide to use our other assets to pay the debt, right? So what did you give? You give your non-cash assets to creditors, right? After you get non-cash assets to creditors, then do you have a liabilities? No more, right? So you will get back your bond. Your liability decrease, right? Because after you pay the debt, I don't have the liabilities anymore. Okay, so that's why your bonds payable decrease. Bonds payable decrease because what? You pay the debt already. That's why your liability decrease, but use your non-cash assets. But remember, non-cash assets like what? Your company's land, your company's buildings. We will record our assets, right? On what? On our balance sheet, right? So when I look at my balance sheet, will tell you what? My land, my buildings, how much, right? Any numbers on our balance sheet, on our financial statements, we call it what? Book value, right? So you should understand your assets, your liabilities on your accounting books, how much for each one. So that's why you should know your book value for your land, for your liabilities. So book value means what? The amount on your accounting books, financial statements. So after I note, I gave them my non-cash assets. How much on my accounting books? And I use that to pay my liabilities. So how much on my accounting books? But remember, when we do any kind of business with creditors, with people outside the companies, they will look at your assets. They will look at your assets. They will look at your values. Use their way, right? So it means what? When we do business with people outside the companies, when we do business with the people in the market, they care about the market value. Okay? So that's why when I told you my book value 100, so if you told me I have my cell phone on my accounting book, I think my cell phone is 100, I'm going to give it to you. Do you look at the same value as me? No, you will look at the value, use your own side, right? So what's your side? Market, okay? So that's why always when any things on your accounting books, when we go to market, we have to compare these two numbers, book value and market value. Market value means the value in the market. So this is the market value, is the value from outsiders. So did you find out when we compare book value with market value, you will have two gain or loss happened. Why is that? I use the simple case to tell you. For example, today you are the debtor. I have the PPE on my accounting books. I told you I have $80. Remember, $80 means what? Book value, right? The value on accounting books. On my financial statement, I think my PP's value $80. Also, I have the liability bonds payable. How much? $100. So I told to creditors, I want to use my PP to pay the debt. So I give my PP to creditors. Okay? So what happened? You think your PP is $80, but outsiders don't think it at the same value. Outsiders think the value is only how much? $60. So what does it mean? Actually, you have two ways to pay the debt. How? You could sell it to the market, got the cash, pay to creditor. Okay? So if you could do this way, first is what? Sold PPE to market. When you sold PPE to market, how much money you can get from the market? So PP to market, how much money you can get from the market? Of course, market value. What's the value they think in the market they are willing to pay, right? So they are willing to pay is only $60. So sold PP to the market, you got the cash. Is market value. So it's what? $60. But what's the problem? In your side, from your side, you think, what's your value? 80. I believe my PP's value is 80. But when I sold to the market, I only got the cash 60, right? So compare to the value you think is 80. So what happened? You think you sold your PP with cheaper price. So that's your loss, right? I believe my value higher, but I sold to the market, I got less cash. So that's my loss, right? How much? 20. Okay? So every time I sold my PP to the market, I got $60. Now what's the next? I used the cash and got 60 to what? To pay the debt, right? So after that, I used the cash and got to pay the debt. So what's your liability? 100, because creditor accept that, otherwise they got nothing, right? So pay the debt, 100. So what happened? $60 to pay the debt, 100. So is your gain or loss? Gain, right? I use less money to pay more debt. So I got the gain, $40. Okay? So you could do that. Sell the PP to the market, got the cash to pay the debt. But today, that's the way you could do that. Today we talk about you sold the PP to the market. The market, the person, just is the same person as your creditor. Okay? So actually the same, you sold to the market and use the cash to pay to creditors. And today we give the PP to creditors directly, but the result is the same. So you can think about it like this way: sold to creditors. Creditor give you the money to pay creditor's debt. Okay? Any questions? So based on this, did you find out when we have a book value, you have to compare to the market value, then you find out for your PPE, you will have the gain or loss when you sold the PPE, right? And when we use the money to pay the debt, we will have the gain or loss on extinguishment. Means when we pay the debt, when we pay the money back, we will have another gain or loss. Any questions? So let you guess. Usually, when we sold the PPE to the market, could be gain, could be loss, right? Depends on what's the market value right now, right? So your first gain or loss could be gain, could be loss. So means what? Means this part could be gain or loss. But let you guess, for the second part, you use the money to pay the debt. We will have a gain or loss, usually. Usually, should have a gain, right? Why is that? Your company is financial difficulty. Will you use more money to pay the debt? Of course not. You will tell creditors, I don't have the money. Can I use less money to pay my debt? So the second one usually should be gain, okay? Because I don't have the money. Will I use more money to pay the debt? Impossible. So for this part, usually only gain. Okay, any questions? So after the transactions, do you have the PP? No more, because you gave it to creditors. Do you have the liabilities? No more, because you paid the debt already, right? So after this, I don't have the PPE, I don't have a liability, but I have what? 2 gain or loss, right? Any questions? So based on this, I don't have the PPE, I don't have liabilities, but I will have 1 gain or loss, another gain. Okay? So based on this, what's the journal entry we use? The effect for your company. You don't have the PPE, so your PPE decrease, right? You don't have liabilities, so your bonds payable decrease. At the same time, I gave the PPE to the market, so I will have a gain or loss. In this case, $20. Also, I use the money to pay the debt, so I have a gain on the extinguish of debt, $40. Okay, so that's the effect for your companies. Any questions? Then you think about creditors. What's the effect for creditors if they are the bank? On creditors' book, told you they have a receivable $100. Why is that? Because you owe them money $100. All right. So for creditors, they have bonds receivable $100. So after the transactions, creditor said, okay, I give out the receivables because you paid the debt already. Then what else creditor got? PP from you, right? So creditor don't have bonds receivable anymore. don't have anymore. But creditor got what? Got PPE. Could you tell me, creditor got PPE, how much it is? Creditor is in the market, so they always look at market value. They think they got the PPE worth only $60. So what happened? You have a receivable $100, but you just got $60 back. Means what? You had a $40 cannot get back anymore. So what's the journal entry account we use to describe? You had a $40 cannot get back anymore. Based on this number and this number, you know $40 cannot get back. Receivable cannot get back means what? That's your bad debt expense, right? So which account we use when your money really cannot get back? You have an actual loss happen from your receivables. Really cannot get back means what? Actual loss happen. Then we should do what? Write off 冲销, right? Remember? What's the journal entry we use to write off your bad debts? Debit, allowance for doubtful account. Credit, receivables. Okay, remember that? When actual loss happen, you should write off your bad debts to tell them I really cannot get the money back. So what's the journal entry we use? Debit, allowance for doubtful account, 备理坏账. Credit, receivable, the money receivable and really cannot get back. Okay? So what's the effect for creditors? Creditors don't have a receivables, but creditors got PPE $60. At the same time, $40 really cannot get back. Okay? So that's why. Did you find out? Receivables, $100 disappear from creditor's accounting book, but creditor got PPE worth market value $60. Also, they have a $40 really cannot get back, so we should write off the bad debt using allowance for doubtful account to describe. $40 is our actual loss we really cannot get back. Okay? So it depends on you are the debtors or you are the creditors. But today, we are the debtors. So we focus on debtors. Any questions? No problem? Fiona, any questions? No? Okay. So let's look at the case. Here, on your slide 85, what happened? Bank loan the money to you, so bond mortgage company is you. So this is creditor bank. loan money to you. So this is your company. So you are the creditor. Oh, sorry, you are the debtor. Okay? Then what's the point? The point is your company cannot meet its loan obligations. So what does it mean? You don't have the money. You don't have the ability to pay the debt. So you do the negotiation with the creditors. The creditors agree what? Accept your real estate to enforce settlement of the liabilities. So creditor accept to get your real estate to pay the debt. Okay? So what's the problem? Your real estate's book value $20,000. Your real estate's market value $16,000. Okay? So your real estate book value $21,000. Market value $16,000. And use that to pay the debt. How much? $20,000. Okay? So what did you give? You give your real estate book value $21,000. What's the market value for your real estate? $16,000. Okay? And use that to pay your liability. What's your liability? $20,000. Okay? So based on this, you should have two gain or loss. First gain or loss is what? When you sold, gave your PPE, you will have the loss on your PPE. So compare your book value with your market value. You will find out this is your first loss. So what's your loss? $5,000. Okay, so it means what? You sold your PP with low price. So you think that's your loss on PP, and use the money $16,000 to pay your liability $20,000. Then you will have what? A gain, right? Usually. So I have a gain. Usually, how much? $4,000. Okay? Any questions? So, based on this, I don't have real estate. Why? Because I gave it to creditors. Also, I don't have liabilities because I paid the debt already. So your liability decrease, your real estate decrease. At the same time, I have one loss on my PPE, $5,000. I have one gain on extinguishment of debt because I paid the debt with less money. So at the same time, you have one loss, one gain. Okay, any questions? No problem. So this is a normal case. You use your other assets, non-cash assets, to pay your debt. Let's look at another case. What's that? You ask creditors become your shareholders. Let's work together to make the company better, okay? So let's look at your slide 87. What happened? Now assume creditor accept what? 320 ordinary shares. So creditor got your company's shares. Okay, creditors got your company shares means what? They become your shareholders. Then how much? Shares, fair value $16,000. So means they issue the shares, share price $16,000. So fair value $16,000 means share price股价。Okay, so use the money to pay the debt, $20,000. Okay, based on this, what did you get? You issue the shares to creditors, right? And use that to pay the debt, so your liability decrease. Any questions? When you issue the shares, do you have the shares value on your accounting book before you issue it? No, right? Issue the shares means what? I don't have the shares before. Today, I give the shares to shareholders. So do you have the value before? No, no more, because today is the first day, right? So that's why we don't have the book value. It's not exist. It doesn't exist before, okay? And you issue the share. What's the share price? $16,000. And use that to pay the debt, $20,000. Okay? Then what does it mean? You give the shares to creditors, so they become your shareholders, right? So do you remember how to recall it? Issue shares to investors. They become your shareholders. So what's the journal entry we use to describe it? They become your shareholders. So creditor become shareholders. Remember how to recall that? If you got the cash, what should we do? Cash, right? Then share capital and share premium. Okay, so this is a normal journal entry we use when we issue shares to get the cash from investors, right? So you got the cash. At the same time, they become your shareholders. So your equity increase. Equity increase means what? Means their right. Investor become shareholders. So their right in the company increase, right? So share capital increase, share premium increase means the equity increase. So this means what? Equity increase. Equity increase means what? Shareholders' right in the company. Increase, right? Okay. So that's a normal journal entry we use. The difference is today we didn't get a cash. We use the shares to pay the debt, right? So the difference is we didn't get a cash today. We use it to pay the debt. So we didn't get a cash, but our liability decreased. Okay? Any questions? So that's why here the journal entry we use is what? We issue the shares. So how much for the share price? $16,000, right? So totally share capital, share premium. Here should be $16,000. That's your share price. And we use that to pay the debt. So that's why your liability decreased. How much? $20,000. So your liability decreased. Okay? And did you find out use less money to pay more debt? That's why we have a gain on extinguishment of debt. So you have the gain. $4,000. Okay, because use what? Use shares. $16,000 to pay the debt. $20,000. Okay, any questions? No problem. Remember how to get share capital, share premium. Share capital, we put only par value, right? Share premium is the remaining numbers. So share capital, we put only par value. So this only for par value. Share premium is what? Is your share price minus your par value. Okay? The question told you par value $10. The shares we total gave it to creditors is 320 shares. Okay? So that's how we got par value, $3,200. Then how to get the share premium? Share price minus share capital, $3,200. That's how we got share premium right here. Any questions? Jia-Chi? Any questions? No problem? Okay. No problem? So based on these two cases, could you tell me if in this case, after you use your PPE to pay the debt, creditor become whom? After you use the PPE to pay the debt, creditor become nobody, right? And use the money and use the PPE, give it to you. I don't have the liability anymore. So I don't owe you money anymore. Who are you? Nobody. You are not my creditor anymore, right? So we are done. We don't have any relationship anymore, okay? How about second case? After this, you issue the shares to pay the debt. Creditor become shareholders. They are not creditors anymore. They become your shareholders. Okay, so you should understand your relationship after each case. Any questions? No problem. Okay, let's say for case 3, if you don't have any problems, let's look at case 4. So please go to slide 89. Case 4, what happened? Still, your company have financial difficulty. You don't have the money. But right now, you still want to pay the money back. But you don't have enough money. That's why you negotiate with creditor to tell them, could we change our contracts? Okay? So modification of terms means change the contract. So what kind of possibility we have changing the contract? Then you should think about what are the 4 basic promises we have on the contract. First is what? Principal, right? Second is what? Contractual interest rate. Third is what? Maturity date. Last one is what? Interest payment date, right? 4 basic promises we have on the contract. So of course, when we do the negotiation with creditors, we will base on these 4 basic promises to ask whether they could give us, for example, could I pay the principal less? So if the principal is 100 before, you told them I don't have the money, could I pay less money? So that's the first term we could do negotiation. So reduction means what? Could we pay less principal because I don't have the money? Second is what? Interest, right? I have to pay the interest each period. So what's the problem? You have to make sure each period you have enough money to pay interest, right? But right now, I have a difficulty. I can't promise that. So could I reduce my contractual interest rate to make lower? Then I could pay less interest each period. Okay? Another possibility is what? Please give me more time. Maturity date is today. I don't have the money. Could you give me 1 or 2 more years? So extension means what? Give you more time. I promise I'll pay the money back, but could you give me 1 or 2 more years? Or could you give me 5 years more? Okay? Last one, interest payment date. What does it mean? When we cannot pay the money today, it's not just because today, right? When we do the negotiation, it means what? You had the trouble not today. You had the trouble maybe long time ago, like 1 or 2 years ago already. So after 2 years, you find out you really cannot pay the money. You just do the negotiation. So last possibility is what? You ask them, before I owe you interest 2 years already, could we pass it? I don't need to pay the interest for past periods. Okay, just focus on the future. So it means what? Maybe (2020 and 2021) you owed interest because you had a problem. It's not only today, it happened for past few years. So maybe you owed interest. You don't have money to pay interest. $10 you owed interest. $10, and today is 2022. 2022, for example. So 2022 is today. So you just ask creditor, this is today, 2022. Could we forget what happened before? Just focus on the future. So means what? That $20, could we forget it? So that's for last term. Reduction for accrued interest for what happened already. Okay? So let's forget for what happened already. So this is the last possibility. So let's skip accrued interest. $20. So could we just skip this part? Focus on the future. So you don't need to memorize it, you just need to know we have 4 basic promises. So what could you do? Negotiate either one and try to find out whether creditor accept. So we will, after the whole process, finally make a final negotiation. Okay? So any possibility depends on the situations. Any questions? So that's why here on your slide said reduction or static interest rate, or extension of maturity date, or reduce face value principal, or reduction of accrued interest. So skipped the accrued interest. So this based on this. So you don't need to memorize, you just need to know 4 basic promises. Then you will know what's the possibility we could do the negotiation. Okay? Any questions? So do you still want to pay the money back? Yes, you want to pay the cash, but you ask them to give you more time, or you ask them allow you to pay less money. Okay, so still pay the cash. So based on the situation, after we change the contract, after that, what should we do in accounting? Okay, on your slide 92. Slide 92 told you accounting for modification. When we change the contract, accounting, how we record the situation depends on what? Whether the modification or term is substantial or not. What does it mean? Whether the change of the contract is big change or not. Let you guess, is big change or not? For example, today, on the contract, you have principal $100. You don't have the money. You ask to do some modification. Okay? So you ask creditor, principal $100, but I don't have the money. Could I pay less money? So when you do these kind of things, you will tell them, I don't have the money, 100. Could I pay $99? Is it possible? Impossible. Why is that? Just $1, 100 to 99. Not big different, right? Usually, you will have financial difficulties. What is a big trouble? So let you guess. Usually, what kind of case you will have? Case 1. You ask, could I just pay 99? Or case 2, you really don't have the money. You ask them, could I pay like $60? Which one you think is more possible? Case 1 or case 2? Case 2. Why? If I have to pay $100 to you. Right now I have only 99. I need to do negotiation with you? No, because just only $1. I will maybe give me, maybe $1 you still could try other way to find the $1, like what? Borrow money from others or ask your friends, so on, so on. It's not that difficult to find the $1. So when we talk about financial difficulty, it means what? Your company really had a big trouble. So it's really a big trouble. That's why we will do negotiation with the creditors. Because when you do the negotiation with the creditors, the news will let investors or let your shareholders or let your creditors think your company maybe will go bankruptcy. So that's a very, very bad news. When there's a very, very bad news, it's impossible just because you don't have the $1. It's because you really cannot afford to pay the money back. Okay? So that's why usually there will be a big, huge, So the multiplication of term usually should be substantial. Means when I want to make the change should be huge change. Okay? So for this one, case 2 means this substantial. 重大的，修改是重大的 substantial. Case 1 is not substantial, but usually it won't happen usually. Okay? So I have to say usually general situation should be case 2. Because case 1, we don't need to negotiate with the bank. We could find other ways to pay the money back. So usually should be case 2. This is a normal case. Okay? But accounting, we will consider every cases and find out what if case 1, accounting, how we record it. What if case 2, accounting, how we record it. Okay? But let you guess, when you think about this change is big change, how many percentage you think this big change? 100 to 99 is how many? Is 1% change, right? So 100 to 99, the change is 1%, right? So for case 2, from 100 to 99 means what? There's 100%. Decrease, right? From 100 to 60. Less how many percentage? 40% decrease, right? When we talk about, in real world, when we talk about is big or not big, it's better we use the percentage. So case 1, the change is 100% because it's $1 decrease. $1 decrease based on the original amount 100, so it's 1% decrease. from 100 to 60, the money decreased $40, right? $40 compared to original money we owed is 40% money decrease. So there you guys, what's the cutoff? When we think the case is big change or not, what's the percentage? Usually we think is a huge change, huge difference. What do you think? How many percentage? Like you do some investment, what do you think? How many percentage of reward, rate of return, 投资报酬率, how many percentage you think you made a big money is a good rate of returns? What's the cutoff usually? You think 5%, 10%, or 15%? The cutoff is a good rate of return. What do you think? It's a big change. 5% is good. 10% is good. How many percentage? Okay. Usually we think 10% is a big change. Okay. So that's why when we want to note the change is big or not, substantial or not, we use 10% as the cutoff. If the change higher than 10%, we think the change is huge. Lower than 10%, that belong to case 1. It's not that big change. Okay? So that's why here told you whether is substantial modification, the change is big or not, we use 10%. So comparing the old debt, so what does it mean, the old debt? The new debt. The new debt and the original debt. So means what? The new contract and the old contract. So this is old contract. New debt is new contract. So for example, if I assumed old contract principal 100, new contract principal 60, right? For example. So at least when we compare these two numbers, they should be have 10% different changed. Then we will think that's a huge substantial. Okay. Any questions? No problem? So that's right. When we compare old contract with new contract, so 100, for example, minus 60 divided by 100, in our case, case 2. So if original 100, when we make a change, you just need to pay 60 divided by original 1, we owe them 100. So you got the percentage, the change. How many? 40%, right? The money you should pay 40%. So 40% higher than the cutoff 10%. So we say there's a huge change, big change. Any questions? You just need to understand the concept, but I don't ask you to compute this process. Why is that? Because I just mentioned, normal case, the contract change should be huge or not? Huge. So what's the necessary? We do the math. Not necessary, right? So just let you understand the concept, but I won't ask you to compute the numbers because normal case should be higher than 10%. Normal case, the change should be huge. Okay? So any questions? No problem. Take a break. We talk about later next hour.